Now, it was hailed as the modern day lay-by, but now Afterpay is getting some consumers into debt.
Yeah, damn man, I really don't know if I should cover the stock anymore. It's got so much controversy and I'm sure I'm going to receive some kind of flack for it in the comments down below. But anywho, one of the most controversial stocks, one of the most talked about stocks, the hottest stocks in the ASX is in Afterpay. And as it continues to grow in terms of users in Australia, New Zealand, and globally, people are going to keep talking about it no matter what. But anyways, welcome back my finance peeps, to the new subscribers and to the ones that have been sticking around for a while. This is the second last installment of the Wax series, and we're going to be discussing today about Afterpay. Yes, the buy now, pay later giant. And I've got this little setup today because there's a lot of exterior noise that's going on around the house at the moment. So I'm making sure you guys get some solid, clear audio through this little mic here up here. But obviously throughout these videos, you don't really see much of my face at all as we go through some of the reports, the slides, and all that type of stuff. But that's beside the point. This stock has seen some serious highs. It's at an all-time high at the moment during this turbulent time. And so today what I want to cover is its business model, its competitors, finance, and outlook for 2020 and onwards to help you determine whether Afterpay is a buy for you. Of course, this is all general advice. Don't take it anything personally and buy at your own risk. So guys, in this episode, if you're ready for some context around this business and my outlook for the future, grab some snacks, take a seat, rest your feet.
I'm not a rapper.
And smash that like button, of course, for the YouTube algorithm, and comment anything below. What are your thoughts on Afterpay before you actually watch this video? I want to know if anybody's buying, looking, what's going on out there in the market, because this is definitely a hot stock for a few reasons. Anyways, guys, let's get into it. So the notorious buy now, pay later platform that's ruffled so many feathers operates as a service in which the buyer sees a good and purchases it now and pays it later. The system is very similar to a credit card or any other zero interest purchase option, assuming that you pay it all on time, of course. Now, to best understand how the platform works and makes money, it basically charges the retailer to use their platform, first through a fixed rate, which right now is 30 cents per transaction, and then a variable percentage that's agreed on, which ranges from 3 to 7%. Now, this is different for each retailer, so that depends on what they negotiate and a few other variations. So obviously with this type of business model, it's a volumes game. The more sales that goes through the payment platform, the more Afterpay make. The payment is made by Afterpay a day after the order is processed, minus the merchant fees to the retailer. Now, with those type of fees, you got to ask yourself, who in the world wants to potentially pay up to 7% in merchant fees, right? When we're looking at MasterCard, compare it to MasterCard or a Visa. Who wants to have a 7% impact on their profit margin plus a 30-cent transaction fee on top of that? Now, for many businesses, making a 30% profit margin is already pretty good, but to take a 7% hit on top of that and basically slash your profits by almost a third, now for that to occur, you've got to have a pretty compelling reason to hop on Afterpay as opposed to using a MasterCard or a Visa payment platform. Now, to have a go at answering this question, I'm just going to take a stab in the dark here, but I think the leaning towards Afterpay stems from two factors. First is that millennials, or the Zoomers or Gen Z, have always been told to stay away from credit cards, and we hear it all the time in the news about crippling credit card debt. So shoppers see Afterpay as an option to stay away from credit cards since it's a free service if you pay on time. And it mentally allows people to budget their shopping into their weekly expenses. Now, I know for some out there, it doesn't make sense. And for me, I don't really get it either. I might as well just use a credit card at that point, because I have credit cards and they offer me way more security, way more perks, and way more options. So this converting of these anti-credit card folks to Afterpay forms the second part of their success, which is their marketing. So if you frequent any social media platforms, in particular Instagram or any online shopping site, you'll see the Afterpay logo quite often. And this sparks an interest in the younger demographic who's looking for alternatives to credit cards that provides very little friction to transacting, which by the way is a win for the merchant also, because you're providing an alternative to what the customer wants and you're getting the sale by the end of the day. But yes, their marketing is on point and speaks to the culture of the company also. Young, vibrant, and you'll see this all within their reports as well. So that's how they make a main portion of their money, and I think it's rather easy to understand. Now, a large portion of their merchants and transactions are also online, and if we have a look at the report in the ANZ region alone, it's about 75% online. What this means is that the closure of retail shops during this pandemic has had a lesser effect than many would have thought when their shares went down to $9. Now, if we're looking at in-store purchases, like, the ones where you actually go to the shop, most of them were actually made through bigger enterprises. So we're talking about your Big W's, your Officeworks, and your Targets, which were actually open for the most part of the pandemic anyways. So how has this business grown in the first half of 2020 in contrast to the first half of 2019? In terms of sales, we see a boost from $2.3 billion to $4.8 billion, which is up 109%. Their user base has grown from 7.3 million active users, which is up 134%. Merchants have almost doubled, and their total income has over doubled, and the losses they've been taken has also gone down over time. So yeah, for any traditional business or business in general, those metrics are very, very impressive. Just think about any other business that we've looked in this series. Growth has generally been 20 to 60% at the highest, but here we're looking at triple digits in growth for many of the metrics for Afterpay. Now hold up, I know a couple of you bears are behind the screen just angrily ready to type your comments away and are wondering why I haven't touched on the losses yet and how bad the company is in that perspective. Now I'm going to do that later on, but let me pay the appropriate respect to this beast of a company, and then don't worry, I'll let the bears come out to play. Another aspect I like about the company is that they tackle the biggest area of critique, which has been charging customers money for late repayments. So what do they do to cover this? They cap late service fees so that there's no accumulating interest or hidden fees. There's also a tool in the app that makes sure this doesn't happen, and have reported the average outstanding customer balance is $211, whereas other big payment platforms, which I would argue are much higher than that. In fact, it's actually in the thousands without the capped late payments fee and potential spiraling debt. Now, I want to take all of these big numbers with a grain of salt. In many of these reports, companies will obviously choose the metrics that are advantageous to their reports, and sometimes it may not necessarily paint the entire picture. Now, this is where I start getting into the bearish territory. So apart from the negative news about the service, which generally is fear-mongering clickbait for the most part, it's obvious with Afterpay that they actually are not profitable as of yet, which is the biggest, by far the biggest bear comment in this stock. But for me, I actually hate the statement. It's generally just like a throwaway statement, like throwing a random number out there and not actually giving some solid figures behind it. So let's delve into the numbers. So if we look at the operating cash flow, which gives us a better picture of how the business is performing and where the cash is coming in from and going out to, for Afterpay, we see that their operating cash flow is an overall negative of $342.1 million. So how did we arrive at this number? So remember, they charge merchant fees before paying them out. So the payments to merchants and suppliers is the amount after they get their fee. The receipts from customers is what they've been paid back to pay back the money that they've paid out to the merchants. Obviously, this number needs to exceed the payments outgoing to make them profitable in this portion of the business. And currently, the difference is $300 million between what they are paying and what they're receiving from customers. But remember, this is a pay over time business. And that's when you have this row down here that mentions the trade receivables. So that's all of Afterpay's invoices to be paid in the future. So if you take that into consideration, which by the way isn't guaranteed that all of that would be paid, then overall they're only actually negative $33.8 million adjusted for the receivables. But if we have a look down further on this page, you'll see that they receive money through other avenues. From borrowing money, which is debt that they'll carry on their balance sheet. They also receive money in the form of capital raising, which happened in November 2019, which by the way isn't the first time they've done this type of capital raising, but the company needs a fair bit of capital to fund its expansion in the US. Now, these other avenues of raising money is for many companies a large way for them to bolster their balance sheet, which you can always look at in two ways. First is a negative way because it dilutes the shareholdings, and taking on debt is obviously a no-no for shareholders because you're grabbing today's money at the expense of tomorrow's cash flow. Or you can see it as the company putting themselves in the best financial position to do well in times like this. So in their balance sheet, they had, as of the 31st of December 2019, $402.5 million in cash, which we can see here is not immediately gone to cover their debt. But if you look at it from a net debt perspective, they're actually in the positive $8.7 million. So that was a lot of numbers to take into consideration, but obviously they're not profitable as of yet. But I would encourage you to think of it like an Uber. This is a market share game. If they're able to execute the strategic plan properly, which they've spent lots of money on in acquiring the right talent to make this happen, it's going to pay out big time. A large portion of the money that they have obtained has gone into marketing in the US, where they've seen a growth of 400% in active users. And given the short amount of time that they've spent there, it's rather impressive. The US market will obviously over time outgrow the ANZ market without a doubt. Another large expense that they've had is also in talent acquisition. And when you see where they've pulled their talent from, it's def's not going to be cheap. Not at all. Because we've got talent from Groupon, Airbnb, CBA, Amex, WeWork, and Visa. 3 out of these 5 are from financial institutions, and the other 2 are from Silicon Valley companies. This is a massive positive for the company. You need this type of experience to expand and grow in different markets, because not only do they bring their experiences, but they also bring their networks with them. And as a CEO, there's only 2 things that you can allocate and make decisions on. That is the allocation of financial and human capital. So having the right team behind you is so crucial when you're trying to make big moves that Afterpay is looking at. Now, the finance space is always tricky, and it's very difficult to recreate the wheel in this space, which is why you see banks with very low growth potential, because there's only so much money that you can lend out before you need more demand for it. So there's been lots of questions as to whether Afterpay will be able to establish that market share to dominate the space. And if the concept is so easy and potentially hugely profitable in the future, what's stopping competitors from coming into the space and overtaking them? Especially when they don't have a particular moat that separates them from the rest. Now, the most common sentiment or thoughts regarding the service and its potential competitors is not only is there other buy now, pay later services, but also that one of the big dogs could come along and provide a very similar service who have already got a large market share. Now, when I mention big dogs, we're talking about your MasterCard, your Visa, or Amex. And it's a solid argument, which I shared myself when I had a solid 5 figures invested into the stock. But now that I look back and wondered why I stupidly cashed out, it actually doesn't make sense for them to allocate resources in the form of capital and time to target an audience whose average purchase is $150 and generally doesn't have a high income. Creating another product that would be, let's be honest, very similar and introducing that to a bank and any other institutions that they are already connected with would require some rebranding. And if we look at what Afterpay had to do to get its brand out there, that being going into a lot of debt and capital raising, it doesn't make any sense for the big dogs to make some move and the resources and all the time that it would take without any guaranteed return on investment. Also, they've already partnered up with Afterpay, like MasterCard and Visa, so just remove any potential conflict from the table in regards to that. Now, if we're talking about any buy now, pay later competitors, let's look at some examples. And one of the most prominent ones is Zippy Dippy, right? ZipPay. Now, for full disclosure, I am a shareholder within ZipPay and I've got some, solid amount of money in that. But at the pace it's establishing partnerships, it's nowhere close to Afterpay. It has some solid partnerships in Australia, but to branch into a market, let's say the US, they would have to convince retailers who are already with Afterpay why they should accept an alternative in Zippy Dippy. Now, there's also the capital aspect in terms of expansion, and for Zip, they're in no position to make that type of move. Now, there's a few other ones I can go into, like your Sezzle, your Klarna. There's a few other ones I just can't remember the name off the top of my head, but I don't think they're going to get close or even touch Afterpay as much as, CBA is going to back up Klarna. The management team of Afterpay have done things right, and they know their demographic very well. Like, just look at their annual reports. It's colorful, vibrant, and speaks to the clear direction of the company. So although I'm not sure when and how profitable the company is going to be in the future, much like Uber, they're expanding into a market internationally. And there's also been some interest from Tencent, who bought 5% stake in the company. And that's when we saw the price really go up. And all of this leads me onto my thoughts about how Afterpay is going to win. As we're talking about competitors, the buy now, pay later space will be won by the person or the company with the most market share. Basically, whoever has the most market share is going to win. And to illustrate my point, I'm going to use Woolies and Coles as an example. Now, in Australia, we have 25 million people or so, you can check it up yourself, who need to purchase groceries. And let's say, for the sake of no bias, 45% of them go to Woolies, 45% go to Coles, and the other 10% goes anywhere else. For Woolies to continue to bring profit, they'll have to obtain market share. And by doing that, there has to be an incentive for shoppers to change their purchasing habits. Now, generally, when we're familiar with one brand and its offering, we tend to stick with it. That, or they can just wait for Coles to screw up in terms of management, or have some kind of controversy happen like rotten food, rotten meat, pins in strawberries, that type of stuff for that to happen, for there to be a drastic shift in market share. So companies like that are competing for market share basically, and Afterpay is no different. They have to be able to convert users from other platforms, which also includes getting people off credit cards to utilize their buy now, pay later service. This takes a lot of strategic planning in that they need to execute their marketing very, very well to capture new customers and get them on board with the system. And in doing that, also be able to continue their boost in partnerships with retailers to eventually get their current users from ZipPay or any other service onto Afterpay. Now, some other controversies that the company is actually going to, and which I'm going to acknowledge, are its legal struggles both in Australia and the US. But what we've seen in both arenas is they've come out to some form of positive settlement. Now, with response to the Rona, they've withdrawn guidance of trying to hit 9.5 million customers by June the 30th. But they did mention that they would still get rather close. The bigger aspect of the business is now trying to balance the growth of the customer base against the risk that they might take during this period. Now, the reason that's important is that Afterpay doesn't want more riskier new customers who may not have the financial capacity to pay it back, or to grab new customers by delving into riskier product areas for the sake of just meeting their guidance. And as of 2020, I see the company as being very well capitalized, as we've seen, and will be able to see this tough period out and may continue to see growth as more businesses decide to move online and take on Afterpay. They have said that they will continue to monitor things on a daily and make tweaks that will be in the interest of making it through this pandemic. So I know that was a lot to go through, but that's my thoughts on both the bullish and the bearish case, and also the facts that are in the reports. What are your thoughts on Afterpay, guys? This is it for me. Next week will be the last episode within the series. I know, I'm sure you guys are sad. I'm rather sad also, but we'll be covering the company Xero. Anyways, guys, have a great weekend. Catch you guys later. Cheers.